how I do.
Assalamualaikum and hi to everyone here. Today we are going to discuss a topic that is financial accounting. This is like the first chapter of the topic. Okay, so here we start. For the first one, the subtopic is the context and the purpose of financial reporting. What is financial reporting? Financial reporting is a way of recording, analyzing, and summarizing financial data. Actual transactions are recorded in books for entry. Well, this is the sequence of financial data. Well, the meaning of financial data is the name given to the actual transactions carried out by a business. So the first step is actual transactions are recorded in books of per entry. That is the first sequence, and then it is followed by the transactions are analyzed in the books of per M3, totals posted to the ledger. The last step of the sequence is transactions are summarized in the financial statements. Onto the next slide. Well, this is the sequence that I told you, that is recording, and then analyzing, and the last one is summarizing. So the next slide is the type of business entity. Well, in financial accounting, there are three types of business entities. The first one is sole trader. The second one is partnership, while the last one is limited liability companies. The sole trader is owned and run by one individual. Personal and business affairs are identical, legal, and for tax purposes. For partnership arrangements between individuals to carry on business, governed by a partnership agreement, fully liable for debts and liabilities. While for the last type of business entity is limited liability companies. The business and personal debts are separated. Shareholders can't be sued for the business debt unless have personal guarantee. And here are the legal differences. The sole trader is not legally separate from business they operate. This is based on the Companies Act 2016, while partnership is legally a separate entity from its owners, based on the Partnership Act 1961. While the last one is limited liability companies, not legally separate from business they operate, based on Companies Act 1961. On to the advantages and disadvantages of sole trader. One of the advantages of sole trader is limited paperwork and cost in establishing this type of structure. Owner has complete control over the business. Owner is entitled to profits and ownership of the assets. Less stringent reporting obligations compared to other business structures, can be highly flexible. And then here comes the disadvantages. One of the advantages of sole trader is owner is personally liable for all debts. Personal property may be vulnerable for debts and other business liabilities. Large sum of capital are less likely to be available of a sole trader. May lead to long working hours without the normal employee recreation leave. The last one is maybe issues of continuity of business in the event of death or illness of the owner. The next one is the advantages and disadvantages of partnership. We start with the advantages, which is less stringent reporting obligations. Additional capital can be raised because more people are investing. Division of roles and responsibilities and increased skill sets. Sharing of risk and losses between more people. No company tax on the business. While the disadvantages are partners are jointly personally liable for all debts unless they have formed an LLP. There are costs associated with setting up partnership agreement. There may be issues of continuity of business in the event of death or illness of the partners. The partnership is automatically dissolved unless a clause is written into original agreement. And the last one is limited liability companies. The advantages are limited liability makes an investment less risky than being a sole trader or investing in a partnership. Makes raising finance easier, and there is no limit on the number of shareholders. Has a separate legal identity from its shareholders. There are tax advantage to being a limited liability company. It is relatively easy to transfer shares from one owner to another. The disadvantages are limited liability companies. They have to publish annual financial statements. Financial statements have to comply with legal and accounting requirements. Financial statements of larger limited liability companies have to be audited. Share issues are regulated by law. And we move on to the next subtopic, which is the nature, principles, and scope of financial reporting. Financial accounting is a method of reporting the financial performance and financial positions of a business. So that's to satisfy the information needs of person not involved in running the business, which means the external users. They provide historical information. While the management accounting is the information needs of management go far beyond those of other account users. They also need to plan for the future. The management information system, which analyzes data to provide information as a basis for managerial action. So for management accounting is basically for internal users. And that's all for me for this subtopic, and thank you.
Doing part 2, which is the user and stakeholder needs. The objective of financial statement is to provide information about the financial positions, financial performance, and cash flows of an entity that are useful to avoid a range of users in making economic decisions. There are different types of users: the publics, the managers, the shareholders, trade contracts, provider of finance, transaction authorities, employees, financial analysis and advisor, government, and public. The purpose of each of the main financial statements are from the bank to the IFRS, to the employees' reports, to the national law of a country, to the national transaction authorities, going back to the bank. The statement of financial reporting. So this is the example of the statement of financial reporting. We can see the fixed assets, the current assets, the liabilities, and the equities. The asset can be measured by liability plus equities. Statement of profit and loss. This is the example for statement of profit and loss. You can see the revenue and the expense. The revenue is the income generated by the business, while the expense are the cost of running the business. The statement made for the period will vary. For example, limited liability company usually publish the statement once a year, while management company will be making quarterly or monthly statement to keep a closer eye on the profitability. The main elements of financial reporting, there are 5 types of main elements: the assets, the expense, the revenues, the equities, and the liabilities. Assets. The definition of asset is the resource controlled by the entity as a result of the past events from which the future economic benefit are expected to flow the entity. There are 2 types of assets. The current asset is a short-term asset that these assets are not depreciated. The movement of usage of them are directly charged to the income statement, such as the item or to sell in a business. The non-current assets are the resource based on the nature are converted into the cash or cash equivalent in more than 1 year accounting period. It is decreasing value from period to period because their usage or impairment of the economic values. The example for non-current assets are the building for business. Liabilities. The definition of liabilities are the present obligation arising from the past events, the settlement of which is expected to result in the outflow from the entity resource embodying the economic benefits. There are 2 types of liabilities: the current liabilities and non-current liabilities. The current liabilities are the type of liabilities that are expected to settle within 12 months after the reporting date, such as the salary payables. The non-current liabilities are the liabilities that are expected to settle in more than 12 months, as an example, the loan from bank. The difference between the assets and liabilities. Assets are anything that is owned by the company to provide economic benefits in the future. It is depreciable. If an asset is increased, it will be debited. If asset is decreased, it will be credited. Generate cash inflows over the years. It's placed first in the balance sheet. The liabilities are something that the company is obliged to pay it off in the future. It is non-depreciable. If an liability is increased, it will be credited. If it is decreased, it will be debited. It is flushed out over the years. It is replaced after total assets are computed. Equity. The definition of equity is the residual interest in the assets of the entity after deducting all its liabilities. As an example, the share capital, dividend payment. Equity can be measured by assets minus liability. If assets increase and liabilities stable, equities will increase. If assets are stable and liabilities are increased, equity will be decreased. The difference between liabilities and equities. Liabilities represents an obligation that must be met by firm. It is amount owned by the entity. Equity represents the amount of fund invested in the firm, which can be either owner's contribution or shareholder investment in the firm stock. Equity holders are known as the owners of the firm and its assets. Revenue. The definition of revenue is increase in the economic benefit during the accounting period in the form of inflows or enhancement of assets, or decrease of liabilities that results in increase in equity other than those relating to contribution from equity participants. As an example, the revenue from selling of goods or rendering of service, interest from bank deposit as well as dividends received from good equity investment. There are two types of accounting principles used to record revenues in income statement, which is cash basis and accrual basis. Cash basis are the revenues are recognized at the time cash is received or collected. Accrual basis are the revenues are recognized at the time risk, rewarded or the controls over the product services are transferred from sellers to buyers. Expense. The definition of expense is decrease in economic benefit during the accounting period in the form of outflows or depreciation of assets or incurred of liabilities that results in decrease of equity other than those relating to distribution to equity participants, such as cost of goods sold, salary expenses, depreciation and transportation costs. It is recorded as operational costs in the income statement in the period they have occurred. The difference between revenue and expenses. Revenues is the money that the entity earns from business. As an example, if you own an ice cream business, revenue is the money that you receive from the buyers. If the revenue exceeds expenses, the business is obtaining profit. Expense is the cost that incurred to generate the revenue. As an example, expense is the cost that you have to pay to run the ice cream business, like the ingredient staff, wages, the rents, and utilities you pay for the ice cream stand. If the expense extends the revenues, the business is in a loss. The capital expenditure. These are the example of capital expenditure, which the definition is the funds used by a business or organization on the purchase, improvement, maintaining non-current asset, which as lands, building, vehicles, and equipment. The expenditure amounts are usually stated in the cash flow statement. The types of capital expenditure are the expense from maintenance of levels of operation present within the company, expense that will enable an increase in the future growth. Revenue expenditure. Revenue expenditure are the cost that is charged to expend as soon as the cost is incurred. By doing so, a business is using the matching principle to link the expense incurred to revenue generating in the same reporting period. This yields the most accurate income statement results. The types of revenue expenditure are maintaining a revenue generating asset, which is the repair and maintenance expense, while generating revenues such as sales, salaries, rent, office supplies, and utilities. These are the types of financial statement principle. Cost of sale is the direct cost attributable to the production of goods or supplies of which by entity. Gross profit. The profit of a company makes after deducting the costs associated with providing its services. Other incomes are the incomes that does not come from the company's main business, such as income from interest, rent, and gains resulting from the sales of fixed assets. The net profit are the business's revenue after subtracting all operating interest and tax expenses. Selling expense, the cost associated with distribution, marketing, and selling of products or services. There are three types. distribution costs, marketing costs, and selling costs. Distribution expense, the cost incurred to deliver the goods from the production unit to the end users, such as the freight costs, the delivery vehicle repairs, the depreciation of the delivery vehicles. The administrative expense, the expense and organization incurs not directly tied to a specific function, such as manufacturing, production, or sales. These expenses are related to the organization as the whole, as opposed to an individual department or business units. The examples are management salaries, clerical salaries, accounting fees, depreciation of office equipment, furniture, and fittings. So that's all for the part 1 of the use of financial reporting. That's all for me. Thank you.